Revenue surged 355%. Core AI business exploded over 400%, holding more than $20 billion in massive orders from Microsoft and NVIDIA, still reporting accounting losses. Nebius NBIS, often called the king of European compute, has just delivered one of the most extreme earnings reports in the AI space. Is it NVIDIA's best ally or the most expensive bait inside the AI bubble? Behind a 1 to 7x price-to-earnings ratio, is this truly era-defining growth, or a zero-tolerance valuation trap? Hey everyone, welcome to Stock Market Breakdown. Nebius has been incredibly hot lately. Companies with growth this explosive and valuations this extreme are exactly the ones that shake investor conviction the most. Today, I'm going to fully break down its expansion logic and financial risks and explain why its current losses are actually proof of ambition. From the numbers alone, Nebius revenue growth is explosive, up 355% year-over-year, with its core AI cloud business growing more than 400%, while EPS remains negative. This scale of revenue expansion proves that the underlying chips sold by Broadcom and NVIDIA are being rapidly converted into real, usable AI compute capacity through service providers like Nebius. This shows that the AI infrastructure cycle is not only still at its peak, it may actually be accelerating. We need to understand what this revenue surge really means. Nebius isn't selling concepts, it's selling real compute power. A 400% growth rate directly punches back at the AI demand slowdown narrative. As long as Broadcom and NVIDIA can't keep selling hardware, compute service providers like Nebius will continue converting that hardware into revenue. The demand pipeline is very real. Nebius is currently facing an extremely rare type of growth constraint: total capacity sellout. Global demand for high-performance compute far exceeds its physical delivery capacity, forcing the company to cap contract sizes. This means future revenue growth is no longer driven by sales execution, but entirely by data center construction timelines and NVIDIA chip delivery schedules. This is a classic supply-driven growth model. Being forced to cap contract sizes is an extremely strong signal in business terms. This is a seller's market. Nebius doesn't have to chase customers. Customers are lining up for capacity, so when analyzing this company, sales numbers matter less. What really matters is data center build progress and supply chain execution. Despite extremely high hardware investment costs, Nebius' gross margin has expanded against the trend to over 70%. This metric is highly persuasive. It proves the scarcity of high-performance AI infrastructure. Customers are willing to pay substantial premiums for scarce compute capacity. At the same time, a 70% gross margin shows that Nebius is maintaining strong operational efficiency and cost control, even while scaling aggressively. A 70% gross margin in infrastructure services is extremely rare. This tells us Nebius is not just a hardware middleman, it delivers a cloud environment with significant technical premium. As long as this scarcity exists, Nebius holds strong pricing power. Although the company reported an accounting loss of roughly $120 million this quarter, adjusted EBITDA losses narrowed significantly. More importantly, management raised its capital expenditure target from $2 billion to $5 billion. This aggressive loss profile is essentially the land acquisition cost required during the AI compute land grab phase, using saturated investment to secure future dominant market share. I am not worried about Nebius losses. What I care about is the CapEx increase. A $5 billion commitment tells us management sees a massive supply gap in the early stages of AI infrastructure build-out. Being conservative is actually the biggest risk. This is a classic strategy of trading space for time. Today's losses are effectively the entry ticket for future monopoly-level returns. Nebius has successfully transitioned into a Tier-1 supplier, with long-term contracted orders exceeding $20 billion. This includes a $17.04 billion contract from Microsoft and $3 billion in orders from Meta. These endorsements from top-tier tech giants not only lock in long-term revenue visibility, but also significantly reduce uncertainty around future financing and capital operations. Being able to secure massive checks from Microsoft and Meta means Nebius' technical architecture has passed the toughest stress tests in the world. This kind of big tech endorsement is the strongest moat a new public company can have in U.S. markets. $20 billion in backlog means the revenue base for the next several years is largely secured. From a valuation perspective, Nebius price-to-sales and price-to-earnings ratios are clearly far above industry averages. However, if the company can achieve its aggressive target of on a 5x annualized revenue growth from the current $550 million to $7.9 billion, today's valuation would be rapidly absorbed. This is a classic case of using growth to offset valuation, where the market is pricing in explosive expansion over the next 2 years. You can evaluate valuation using static numbers alone. A 1 to 7x PE is expensive, but if revenue grows 1.5x next year, the PE compresses very quickly. Buying Nebius is essentially buying a call option on a growth miracle. The key question is whether that 1.5x target can be executed. The biggest risk facing Nebius is its extreme external dependency and execution pressure. Aggressive expansion relies heavily on NVIDIA's chip supply. Any delays in hardware delivery or setbacks in data center power, land acquisition, or cooling infrastructure will leave a 1 to 7x PE with zero margin for error, potentially triggering violent stock volatility. This high leverage, high expectation model places extraordinary demands on management execution. To sum it up, Nebius is one of the purest AI compute expansion plays in U.S. markets. It has big main customers and reported growth north of 400, but execution risk is extremely high. This is a stock where you double if it works and get cut in half if it doesn't. This is Stock Market Breakdown. See you next time.